Hello, everyone. Thank you for joining us here at the Rutgers ESOP Symposium. I'm Ted Margarit, Managing Partner here at Paralign Capital Partners. I'm joined today by Amy Arndt at Ballard Spahr, Regina Carls at JP Morgan, and Renee Lewis at Polsinelli. Thank you for joining us in our conversation on Project Luster. Maybe I'll get started with some introductions. Amy, do you want to introduce yourself?
You bet. Thank you. My name is Amy Arndt. I'm a partner at Ballard Spahr. I run our owner-managed closely held business group, and I'm on the firm's board of directors.
Great. Regina?
Sure. Hi, my name is Regina Carls. I head up JP Morgan's National ESOP Advisory Group. Our team partners with our corporate bankers around the country on all ESOP-related transactions.
And Renee?
Hi, I'm Renee Lewis. I'm a shareholder at Polsinelli, and I'm part of our ESOP practice where we represent lenders, companies, and trustees in ESOP transactions.
Great, thank you. And mentioned before, Ted Margarit, managing partner here at Paralign. We are a merchant bank, which means that we primarily focus on advising business owners through ownership transitions, but we also manage capital where we invest in support of those transitions. And we recently did that here at Project Luster, what we're, for confidentiality reasons, calling Project Luster in conjunction with the partners we have here on the call. Maybe to get us started, Amy, do you want to start off with an overview of Project Luster and how it came to be?
Sure. Thank you, Ted. So I represent a company here that is a specialty distributor in the Midwest. And they're looking at succession planning and a potential exit transition for the ownership group. And they came to me originally with an investment manager agreement, an investment banker agreement to go to market. And they were looking at selling the entire company and transitioning the direction of their company and the ownership of their company. And as we got into that process, they had several advisors involved, and we're sitting around our conference room table, and it became very clear to me that there was an ownership group, or excuse me, upper management group that was very interested in the succession and the pitfalls of what may happen if private equity came in and took over the company. And so we started to look at different strategies. There was a perception of lack of liquidity of the company on behalf of the ownership group that was preventing them from going forward in a different manner. And so we started to look at different options. And I thought of Paralign Group because there's a Paralign fund that I thought would be really beneficial in this structure, and also just the planning and capabilities of different ways to increase liquidity of a transaction. And so I introduced them to Ted and his group, who quickly got involved and did some modeling for them. And it became very clear that the options were much broader than they originally had anticipated. And the key management were very interested in going down this route. And so we looked at several different structures, ended up with a redemption and contributory ESOP structure, which we'll talk about on this call. But I think one of the most important points, just from an advisor perspective, dealing with clients in this market, is that there are a lot of different options involved. And it's not just going to market, and it's not just figuring out if private equity can come in, or if you have a management succession plan already set up early stage in your company. There's a lot of different options, and there's a lot of different options that are emerging in this market that really bring employee ownership to the forefront. And so this was a really exciting opportunity for this client, very nuanced transaction, which we'll talk about here. And with that, Ted, I'll turn it over to you and maybe describe just a little bit about what we were able to do with regard to the Paralign Fund and getting equity involved in this transaction from that perspective.
Yeah, and Project Luster was interesting. It's a second generation business, and the goal was, and where they were going down the private equity route originally, was seeking liquidity. And the business owner mentioned to me at one point that he didn't need 100% of the purchase price in cash, but his perception was that ESOPs were effectively limited to what you could borrow. And being a conservative fellow, his view was that number that he would be willing to borrow to fund the transaction was relatively small. And that, I think, highlights what I view as an advisor in the ESOP market as a real one opportunity, but I think it really is the holdup for a lot of business owners why they don't pursue an ESOP. is that there's this gap in liquidity between, hey, I can sell the private equity, I don't really feel great about it, but I get a check. Versus if I sell to an ESOP, I feel great about it, but I don't get any money. And so why am I selling my business? And so what in this situation really highlights that, but what we're trying to do here at Paralign is to bridge those gaps and provide additional capital to do so. What's unique about Project Luster was not only do we make an investment, but simultaneous with this transaction, the company actually made an acquisition that we had to fund. And as another source of liquidity, we executed a sale leaseback. And it was bringing all of those elements together to say, okay, here's how we can grow this business. Here's how you can feel great about it as an ESOP and give your management team who's built this business to where it is an opportunity to run, but at the same time achieve this owner's liquidity goal, which call it 50% of the purchase price roughly in cash, and bringing all that together allowed us to achieve that result. And so I think it is a really interesting case study. Maybe just when we talk about sort of the Paralign piece, just for a second, I'll just use a simple example of how we invest. So let's just use for illustration, a business worth $100. Our kind of investment thesis is we're pari passu with our client, the business owner, in that we invest in the seller notes and warrants alongside them. So what that means is in a $100 business, let's say they borrow $30 from JP Morgan, and that's your traditional, revolver, term loan, what have you. Ordinarily, you'd have $70 of seller notes. We could step in and say, hey, we'll invest $14, and 14 over 70, we get 20% of the seller notes, 20% of the warrants, and then we sign the same subordination agreement. So I sort of differentiate us from like a mezzanine fund who would come in and say, hey, we'll loan you $14. We'll be junior to JP Morgan, but we're senior to the sellers. We're sort of taking that horizontal strip in the capital structure and going vertical with it to say, hey, we're junior to the bank, but we're pari passu with the sellers on that same basis. So going forward in this example, every time a dollar is made, of payments, interest or principal on the seller notes, 80 cents goes to the seller, 20 cents comes back to us as return on our investment. And so that's just a simple way of how we do that. And as part of Project Luster, I think really kind of illustrated how this can be attractive for both the seller, but then it aligns us as the advisor, and we only invest in our clients, but it aligns us as the advisor because now we're setting up the structure and we have skin in the game. And so at closing, yes, we've completed the deal, but in an ESOP transaction, unlike a sale to private equity, where at closing the deal sort of done, in an ESOP transaction, closing is really the start. And now we'll be partners with this business owner and with this business for the next 10 or 12 years as we work to pay off first the bank debt, second the seller notes, and then third, maximize ultimately equity value for the benefit of the employees through their ESOP, as well as to us through our warrants. And I think as we look at that, and why I was really excited to be part of this group here today, is that it takes a village in that the nuances of how the ESOP is structured and how our investment comes in really does impact both the bank facility that Regina and Renee can speak to in a minute, but it also entails a bunch of corporate structuring that Amy, you and your team were instrumental in. So maybe looking at it just to shift gears a little bit to the bank side, Regina, this was I think a really an interesting case study. I always think of this as sort of the sponsor ESOP, so to speak, but I'd love to hear from you kind of how you evaluated, how the bank evaluated this and thought through the structuring impacts.
Sure, thank you. So to start, while we were not the main bank to the company at the onset, we did have a relationship, which is always very helpful going into a transaction, having some background on the company. So it really helps from an underwriting perspective. Things we liked about this company was its very strong market position, which we felt strengthened the credit. And then in addition, we felt the company had really efficient operations, which speaks well of the management team. I would also add that having Paralighn's involvement as an investor to commit capital was also helpful as it reinforced their perspective in the company and their view of the management team. So we're kind of aligned in that front going, right out of the gate. So as Ted highlighted, this was not a simple transaction by any means. The ownership transition was a bit unique, and from a unique standpoint, I would say that most of the ESOP transactions that we see today have been where they sell 100% of the stock to the ESOP at close. This, however, as we mentioned, was considered a contributory structure, whereby the company redeemed 100% of the stock at close and then contributed shares to newly formed ESOP. And then concurrent with this transaction, the company was also making an acquisition of its largest competitor, which was going to be closed alongside the corporate redemption. Added to that, we were conducting a sale leaseback, as Ted alluded to, following the transaction, that we needed to incorporate the proceeds of that into the overall underwriting structure. And then as part of the corporate redemption, we were also pursuing investment from Paralign. So there's a lot of moving parts. As Ted alluded to, this did take a village, a lot of negotiating back and forth to understand, and having a sponsor-like investment into the transaction, which was an ESOP transaction, which was a bit difficult, or I shouldn't say difficult, was a little different than what we're typically used to seeing. So the deal closed as a two-bank syndicated transaction where we had both a revolving line of credit and a term facility. The bank needed to underwrite the transaction, even though the ESOP was being adopted post-close, as though the ESOP transaction had closed under both scenarios to understand that the company could support the deal with and without the ESOP. We also needed to incorporate the synergies from the pro forma acquisition into our transaction to ensure that those also would fit from a regulatory perspective on a total policy of total debt. As well as get creative with our covenants to incorporate some of those into our covenant structures. And as I said before, while the sale leaseback was going to be happening post-close, we did underwrite it assuming that the deal closed concurrent, and that was the seller that was being paid down, so that we had provisions in the credit agreement in the event that didn't happen. But again, factored it into our initial underwriting. And then finally, with a sponsor involved, we alluded to earlier that there are some terms that are very common in sponsor-related transactions that are unique to an ESOP transaction. So we had to get creative into how we could get comfortable with some of those provisions. So, appreciating all these various moving pieces was helpful to have Renee supporting the team from a legal perspective. And so I'm going to transition over to Renee to just kind of talk about how did you protect the bank given the uniqueness of this transaction structure and the dual nature of Paralign's role as a both investor and an advisor.
Thanks, Regina. This was definitely a unique ESOP transaction. In this case, the ESOP was not, the contributory ESOP was happening at a later date than the closing. So what we needed to do is include in the credit agreement the reps and covenants that you would normally see for an ESOP company that is a borrower, but they were triggered once that ESOP is adopted. Now, once that ESOP is adopted, we want to make sure that from the bank's perspective, we've reviewed those ESOP transaction documents. We've reviewed the plan, the board resolutions, any contribution agreement that the trustee and the borrower may have had. So we had to build that also into the credit agreement that the ESOP transaction can occur subject to a number of condition precedents so that we can actually review that and make certain that the documents are in compliance with the RISA and they work with the bank's requirements. Additionally, as Regina mentioned, because this was a sponsor-like deal, which is unique in an ESOP transaction, equity cure rights are common. They're not necessarily common at all in an ESOP transaction. So the parties really had to come together to work for a solution as to how equity cure rights can work when your borrower is 100% ESOP owned. Because the ESOP, the tax benefit for 100% S-Corp ESOP is significant. They don't pay any taxes. So that has to be considered in light of trying to obtain equity cure rights for the borrower as well. And then another point to bring up is the borrower was an S corporation. And so the requirements to be an S corporation are, there are a number of them, one being that there can only be one class of stock. And we want to make sure we can protect that S election for the borrower, again, because of those tax benefits. We don't want to lose that. The borrower doesn't want to lose that. So we'll build in covenants and reps that they're going to comply But from the start, what we want to do is review their warrants, review their notes, because those warrants and notes can be deemed a second class of stock if certain requirements aren't met. So it's important that those are reviewed to ensure that the borrower is compliant with the code and the S corporation requirements. Additionally, because the borrower is going to be an S corporation, Code Section 409P, which we could spend hours on, is there to protect against any S corporation abuses. And so what they do is they're going to look at this 409P test, looks at disqualified persons to make sure they don't own more than 50% of the ESOP shares, and that includes synthetic equity. What's important and unique here is Paralign owns 10% of the ESOP stock. And so they're a disqualified person. So you want to make sure Paralign is pulled into that 409P testing, and it's included to make sure that the borrower is in compliance. And the borrower will be delivering to the bank annually that 409P test. And then lastly that I wanted, and I think Ted alluded to this, is Paralign is a subordinated creditor. Really, they're treated really similarly to the seller. So you want to make sure that that subordination agreement is signed by Paralign. And it pretty much will track very similar to the seller notes.
Yeah. Well, thank you, Renee. Maybe just a group discussion here. I'll interested in each of your feedback, given that you have different constituencies, one in this transaction, but also are working more broadly with both ESOP companies and non-ESOP owned companies. What are you all seeing as the market? And do we think that with additional sources of liquidity that play well, I'll call it, within an ESOP structure, do we think that there is the potential to create more ESOPs out there? I mean, there's a number of folks, Pete Stavros, of course, and a number of different centers and organizations that have come up in the last 3 or 4 years that are trying to really promote the idea of ESOPs as an ownership transition vehicle. But do we think that this helps solve the economic problem? Maybe I'll kind of moderate here. Regina, I'll start with you on the sort of the more economic side, and then I'll turn to Amy and Renee.
No, I think it absolutely does, because to your point earlier, sellers are looking at proceeds at close. And certainly there are a lot of benefits of ESOP structure, the tax benefits being one, the ability to give equity to employees who've helped drive the business over a long period of time. But they certainly want to monetize their biggest asset. And the tax benefits do help with financing of it, but it typically provides where a bank can't provide 100% financing at close. Having a seller note is attractive from an investment return, but to the extent they want liquidity, more liquidity at close, this will bridge that gap and make them a bit more attractive in the marketplace, as well as I think it's going to be important for private equity. The more they play in the space and understand how they can partner alongside an ESOP, I think the awareness is greater, and I think you're going to begin to see, especially as we're trying to build that bridge that wealth gap, more and more investors come to the table, which we're seeing today.
Mm-hmm. With different vehicles, right? I mean, I think that's what's interesting, is that there's a whole group of folks that are focused on more traditional mezzanine. I think there is an angle I'm really interested in, Regina, that we've talked about before, around large mature ESOPs actually looking at acquisitions. So you would become ESOP owned, not through your own ESOP, but through someone else's ESOP effectively. So there's a lot of different ways. I think it's really interesting what's happening there. Amy, you were, I think, gonna say something from your perspective and your practice.
Yeah. So I usually get involved on the front side of working with these clients, working through transition. And one of the things, I think it opens up a whole new world for a lot of these businesses who are unaware or have this perception that the ability to get liquidity out of the company will drip out over 20 years, and they're not going to be around 20 years from the time of the transaction. And so they kind of feel like their hands are tied, or have been tied, as far as how do they transition when they're already of a certain age, or a lot of different factors involved. I think there's also the element of the uniqueness of the transaction, of bringing in the level of sophistication, not only with regard to the financial structure of the redemption, or of the initial redemption and transaction, but the ongoing partnership that a company can sign up for or is signed up for in a transaction like this, it's not terribly, that's the wrong word. It's very complicated. It's enjoyously complicated for us nerds to figure through a transaction like this. Our transaction notebooks cannot be condensed into one zip file, which is my favorite type of transaction. But what's really cool from a client perspective is that they have a partner that continues forward and continues as a financial partner with them forward to figure out the goals of the company. And it's not just, hey, we're going to do an ESOP and thanks a lot and we're out the door. It really is a relationship that helps the company continue to grow for the benefit of the employees. And it's something that I really enjoy in my practice because it's not just about getting clients to the next step. It's about seeing these companies grow in a different stage. And that's where we're at, is seeing private equity come into this market. It's really it's really opening up a lot of different avenues for these clients that makes it very exciting from my perspective as a legal counselor and trying to figure out how to help these companies transition.
Mm-hmm. And thanks, Amy. And I think what's interesting there is that, we are private equity, but we don't take board seats, and it's just a very, very different structure. And what I mentioned in our pre-call was, we have this vision that ESOP should be an asset class, like private equity has made LBOs an asset class, but it looks different. And from an investor perspective, the timeline is generally a little bit longer, right? These aren't 5-year turns like private equity tries to do with LBOs. These are longer duration investments, but they're tax advantaged, which addresses some of the risk. But you have to align that and sort of make sure there's a good fit between that investor and the ultimate client. Putting a short-term capital solution into an ESOP is not going to work well. So very interesting. Renee, what thoughts do you have?
Yeah, I don't know what else more I can add. I agree with Amy and Regina. I think we definitely need for the this type of structure in the ESOP community. I think it will allow for there to be more ESOP transactions, more ESOP owned companies, which this is what I've done for 20 years and what I'd like to see more of. So I'm all in favor of it. And I think it's great that there's another viable option for sellers and companies to look at if they're interested in doing ESOPs. And the fact that that Paralign has that ESOP knowledge is super helpful to the companies, because you are going to be in this as an investor, and you can really help the companies on that side.
So Renee, sticking with you, so let's take the flip side, because my view, we've in the, I don't know, dozen or so transactions, we've only invested in a few.
Mm-hmm.
And there are some situations where we help them become an ESOP where I would have loved to invest the money. They didn't want it. And so what are some of the considerations you think business owners would have of why they may at least be aware of, or may ultimately, given their objectives, shy away from? What are some of those things that you think are there?
Oh, why they don't want the investment versus why they may? Well, I think one might be the liquidity, right? They might want more liquidity, in which case having you invest is beneficial to them. There may be concern of having another party kind of involved, right? I think for some owners, I think transitioning to the ESOP is difficult in general. They've built this company, they're the founders, and they need to transition that to a new owner. So I think that's hard for a lot of owners. So that could be definitely one reason as to why adding an investor is adding, more oversight. They'll think of it as more oversight, someone else having more input into their company, I think.
It's all the reasons they didn't want to sell the private equity in the first place.
Well, exactly, right. And but it is a unique private equity, I think, what you guys do. But I do think, that's why.
Yeah. Amy, were you going to add something to that?
Going to add, I think that's it. These business owners, first gen, second gen, third gen business owners are not used to answering to anybody, and they are it's kind of this, amorphous concept of, okay, who's running the company now and who's going to be looking over my shoulder? And that's one more party that's going to be looking over my shoulder. But in this structure, it's aligned with the seller notes, and it's aligned at a level that makes it seem consistent. And it's a learning curve to get there. But I think that there's so much counseling that goes into the business owner part of this of, okay, as long as you have a good management and team in place, nobody wants to come in and run your business for you. We just want to come in and make sure that it's being run consistent with the covenants that we've entered into with regard to a particular transaction. And so that just becomes paramount in discussing. But yeah, Renee, you're exactly right. Just how many people are looking over my shoulder. So I think there's that discussion that needs to happen.
And maybe Regina, from your perspective, both in general in terms of advising business owners, but also from a lender perspective, what are any considerations that haven't been mentioned yet that you would have for business owners to consider as they looked at sort of ESOP or otherwise, or ESOP with outside capital?
No, that's a good point. I think we found there's awareness of ESOPs because I've gone back to the early 70s, but I think there's a lot of misperceptions of what you can and can't do with an ESOP. And I think the transition to the S Corp in 98 and the 100% structure really has dominated our space for quite some time. There are companies that are kind of revisiting what they didn't think they could do with an ESOP years ago, and now understanding there is a lot of flexibility in the structure, and the ability to bring in capital has only added to, I think, the interest owners have, as well as transitioning to employees over time. So my suggestion, they're run a dual track. I mean, there are many transactions we've seen where companies have looked at both the sell side in conjunction with an ESOP and understand the pros and cons. There's not a one size fits all for any company. But I think understanding that this is on a level playing field with all the other alternatives is important, and really understand the features and benefits of the structure, because the companies do perform well. As Ted alluded to, they're very acquisitive. There's capital raising. There's a lot of opportunities to continue to grow. And the misnomer is, if you put an ESOP in place, you put it in place and forget about it. There's nothing else to be done, which could be further from the truth.
Yeah, that's right. Well, and I think, my consideration I would just put out there is that it takes a village. I mentioned this earlier. The ESOPs are complex, and they just have much more interrelationships as part of the structure than an LBO buyout. And I think, part of the goal of this conversation was to highlight how, from the company side, the lender side, the investor side, all of this has to fit together to work properly and really support the business and maximize the outcome for everyone, which is not just sort of the seller, and not just the bank, not just us as investor, but also the employees. And I hope this was beneficial for everyone today. And thank you for joining us here at the 2024 Rutgers ESOP Symposium, and look forward to future conversations. I know, speak for myself, I speak for everyone really. If any questions or like to discuss more, please reach out to anyone on this video today. And I know we'd be happy to talk more about it with you. So thank you for joining us.